Welcome, everyone. We're going to go ahead and get started here. My name is Allison Rindelman, part of our customer success team here at YCharts, and I'm very excited to introduce our two hosts today, Caleb Eplett, Chief Product Officer here at YCharts, and Josh Brown, CEO of Ritholtz Wealth Management. Today, to discuss everything that was 2020, we've enlisted the help of Josh Brown to break down our charts of the year, with charts provided by advisors, investors, analysts, and friends of YCharts across the industry. They're going to help us look back on some of the biggest market movements, stock stories, and economic figures of the year. Please note that the content of this webinar is meant for educational purposes only and is not intended to be used as investment advice, nor is YCharts acting as an advising party regarding client funds in any way. Finally, we'll post a recording of this webinar to the support topics page of YCharts, and a copy will be sent to all attendees. Now I'll go ahead and hand it over to Caleb to get us started.
All right, thanks, Allison. Big one today. Super excited here to be joined by Josh, a man who needs no introduction, but I'll do my best to give him a little bit of one. You might know him as the Reformed Broker. You probably know him from CNBC on the Halftime Report. Several books you've written, Josh. I know the most recent one out there, How I Invest My Money, is on my reading list. I think it should be on everybody's this holiday season. Super excited to have you on board. We've been working with you.
You left some stuff out. Triathlete.
Oh, all right.
I mean, I don't know how much time we have, but I just want to make sure the bases are covered.
I think you're probably our best dressed webinar guest too with that. That's a great tie. So
no doubt. Thank you. All right. What do we got today, Caleb?
You can tell Ben I said that too. So
I will.
All right. Well, let's jump right in. We've got a lot of charts to cover today. I'll kind of quickly tee up these charts that as we go through. As Allison mentioned, these charts were all submitted from different experts, influencers, investors in the industry, and we've got a great chance here to get your take, Josh, on what's happened in the market this year, and kind of use this as a way to look back and remember a year that was memorable in many, many ways.
Do we want to remember this year, really?
I guess it depends. The returns might indicate so, but I think there's a lot we want to forget too.
That's fair. Financially, we want to remember this year.
Fair enough. All right. So let's jump in. Our first category here, market index movements. And our first chart comes from a very good friend of yours, your co-host on the compound there, Michael Batnick. And, Michael's, he's highlighting here, some of the volatility this year, right? Looking at the Russell 2000, just the down, the max low it hit this year and closing, what seems to be on a new high. I think the question I'd like to ask as we talk about this chart, and, it really captures a lot of this year. You mentioned a year to forget, but where does 2020 kind of rank in your mind as far as, years that you've been in the markets or been following the markets as far as just volatility and notable movements?
There's just nothing that even compares to it. There's no analog that would make any sense to put alongside it. It is maybe the most unique year I've ever been through, other than 2008, and a lot of the trauma from 08 actually spilled over and took place in early 09. But then the S&P finished that year up 25%. So it's hard to talk about that being comparable to this. This is its own thing because we had the fastest bear market ever, followed by the fastest bull market ever in the S&P. And here's what's interesting about this chart. When you look at that May-June period, you see small caps topping out, and they just were nowhere near the pre-pandemic highs at the time that the rest of the stock market was. And people said, you see, it's just FANG stocks. It's just Apple, Google, and Facebook and Microsoft, and the pandemic is so great, and Amazon. The pandemic's so great for them, and it's so bad for everyone else. And then it was like a switch was flipped sometime in late July, early August, and small caps just went bananas. And I think that's vaccine related. And that was also the low for the infection toll was late summer. So I think you started getting really good data on vaccines, and the death rate and the infection rate hit their lows for the summer, and small caps just went nuts. And that really still hasn't reversed itself. And Michael shared with me yesterday that if the year were to finish right now, small caps lost the entire performance disparity versus large caps. They made up for the whole thing. They're 1% behind the S&P 500 names, which is a huge about face for that asset class.
Absolutely massive. And I mean, that actually walks into our next chart here really well. Here we've got the S&P 500 equal weight, but we're dividing that by the S&P 500, right? So Lyn's kind of showing us by equal weighting this index, you actually have a chance to grab some more alpha, in a lot of market conditions, including the second half of this year. Now, obviously no small caps in the S&P 500, but is that same effect what we're seeing here, or is there something else kind of driving the performance of the equal weighted index?
I think this is a question of when you pick your starting point. And by the way, shout to Lyn. I like the chart. I just think whether or not equal weight is a better strategy than market cap weight is a function of where you choose to start. If you want to start measuring this in, I guess this looks like 1989 or 1987 or 1990. I can't tell, but that's fine. I understand what the chart is showing, but then look from 2015 to now, and you lost a great deal of that alpha of equal weight versus market cap weight. So I think, like most things, this moves in cycles, and I think depending on where you want to start it from, you can make that point that it's better. And then if somebody wants to say no, cap weight is all you need, which I think would be like the Bogle argument, then you could choose a different starting date and have the data make your argument. So you want to be careful with things like that. I don't think there's a right approach. I think both approaches have their merits. And then if you're choosing one versus the other, the caveat is expect significant periods of time where you look like a genius and significant periods of time where you don't, and you have to be able to live with that. You can't have it both ways.
Well said. All right, moving into our next chart. Dasarte here.
That's my boy right there.
He says it all the time, right? Onward to greatness is working. But I think Dasarte's chart here is really calling out. There are certainly, like everything in life that you're working on in the long term, there are going to be battles, there are going to be downturns, and the beginning of this year was one. But here, showing the market from when things started to come back to the end of the year, if you stayed invested, you had some pretty good returns to show for it. So, I'm curious, Dasarte talks about these things often and the emotional side of investing. How do you think about that? And what do you have to say about the emotions of staying invested?
Look, this is a very powerful image for investors at every level of experience or income or wealth, because what it's showing is that there's a reason people take risk. It's because risk is rewarded. Not every risk is rewarded equally. Not every risk makes sense for every investor to take. But generally speaking, when you were buying stocks in March and April into the teeth of this pandemic, which many people we were, when you were doing that, you were taking a risk that a lot of other people were not willing to take, and you were rewarded. Now, you were rewarded really quickly this year, and I think that's because we didn't have like an economic problem. We had something that was very acute and severe, but it was exogenous. And I think that's and then of course the actions of the Fed and Treasury. So when you're buying stocks in March and April and people are like, what are you doing? How could you possibly buy stocks? It's the zombie apocalypse that we've been waiting for. It's here. What they're not remembering is that every action provokes a reaction. And what is the reaction of the monetary policy and the fiscal policy that will surely come? And they weren't counting on us doing UBI, universal basic income, under a Republican president. That's what happened. True story. We weren't counting on that. We weren't counting on the Fed buying junk bonds and then moving up the ladder, investment grade bonds. The Fed is buying Google bonds right now. You know what else they're doing that I don't understand? They're buying mortgage-backed securities. Do we have some sort of an issue with mortgage rates right now? I don't think so. So we were putting money directly into people's accounts. We were doing expanded unemployment to the point where people without jobs were making more money than when they were working. So if March, April, you didn't know that would happen, but you had to assume there would be a reaction. So somebody saying, why buy stocks here? Why take that risk? Well, because these things don't happen in a vacuum. And some of the biggest investing opportunities in history were provoked by what at first was very bad news. World wars, right? All types of horrible things. financial crises, etc. So I think that's what his chart is illustrating, the second half of that story. The first half was ugly. The second half is recovery.
Yeah. So speaking of that, right? So Howard here, Howard, co-founder of
We can
StockSwitch.
skip this chart. This guy literally doesn't know anything. Like, honestly, good dude. Come on, next.
All right, let's fly through here.
All right. No, I'm kidding. Let's go back. Wow, you were really gonna do that.
Hey, I'm here to drive for you, Josh.
That's not cool. All right. No one expected the Russell 2000 and small caps to hit an all-time high in light of a contested election and the impact of COVID-19. No, he's exactly right. There's no reason to have expected. Think about small caps versus large caps. The primary characteristic separating small from large is that these are smaller companies. It's not as easy for them to sell new shares of stock or to refinance their debt or to get loans if things get rocky. Like, by definition, a tiny company versus a large company. So they end up being, the equities of these companies end up being more economically sensitive. They do worse in a rough patch, but when you recover, they rocket higher. Historically, small caps have led large caps in recovery periods, the early stages. Okay, so that is exactly what played out here. The thing is, it didn't take years to play out. It took like 3 weeks. Over the last 3 weeks, small caps caught up to the bounce in large caps. But if you say to somebody, all right, 22 million people lose their jobs. We have a situation where oil prices go negative, because why not? That makes sense, right? 250,000 people die, 15 million infections, businesses shut down in states all over the country, small caps new all-time high. What? Why would that happen? Gets back to my point. Risk was rewarded, and it happened quickly.
Yeah, I mean, especially notable, right? We've got monthly bars on this chart, and you can see that move in November, which you mentioned, right? I mean, do you think a lot of that was just driven by the election in November and people kind of getting comfortable with where things were headed?
This is cynical. I think it's driven by people who missed the recovery, and they use small caps for beta to catch up. It's a performance chase. If you didn't make money this year, you're like, as an active, if you run institutional money, or you run a 40 Act mutual fund or an active ETF or separately managed accounts for RIAs, whatever you do, if you didn't make money this year, you're fired. Everybody knows it. There's just no two ways about it. You cannot justify active management fees of any kind if you got this year wrong, especially the last 6 months. It's been so easy to make money. Even I make money. All right. So that's what's going on. So now what do? So they missed Facebook going up 100% and Apple and Amazon. All right. They weren't early enough. What do? Well, you buy a $5 billion market cap and you ride that thing to 8 billion, right? That's how that works. So that's what you're seeing happen. Makes perfect sense to me. I totally understand it. And I think it continues into the end of the year.
All right, let's jump into Rita's chart here. So Rita, Rita takes on the emotional aspects of investing head on. She loves the financial planning aspect of their clients. What she's showing here are different asset classes, even blended portfolios or balanced portfolios. And just the fact that, whatever you're invested in, it's about staying invested in the long run, right? And sticking these things out. Talk a little bit about here, right? We're not only looking at equities here, we're looking at all types of asset classes, portfolios, and just the ride that was, 2020 for these different types of investors.
Well, I think, first of all, I apologize to Sean, but Rita is featured in my new book, How I Invest My Money, which is available on Amazon now. Pick up a copy. Great stocking stuffer, but Rita's chapter is great. And I think what we're really saying here is that you don't know which of these squiggly lines is going to end up at the top and which is going to end at the bottom when the year begins. Nobody actually knows. So it just so happens that the S&P 500 was the leader, and it's been for the last few years, but there's no way to know that in advance. But so having a diversified portfolio, it means you're going to give up some upside by owning the underperformers, but you're never going to take all the downside of the worst of the performers. But the other thing that this is showing is that all of these asset classes or all of these funds had positive returns. And I think that's really the key thing to understand as well. You did well in bonds, you did really well in stocks, and there are many ways to skin a cat. So, what proportion you own these things in should have a lot more to do with your own risk tolerance and time horizon than it should have to do with any kind of forecast for that asset class's 12-month forward return.
All right. Well, jumping out of some of the broad index performance and focus a little bit more on the economy in a broader scope, or I guess maybe you tie Bitcoin into the economy, maybe you don't, but Tyrone's here to remind us that Bitcoin and cryptos had another wild year. Is this an asset class that's benefiting from people expecting inflation and being unsure about traditional currencies, or is there something completely different going on here?
I think this is about the dollar. I think it's about just speculative fervor in general. Like people are doing wild stuff with their money right now, like buying shares in collectible cars and trading like there's like a baseball card craze going on again, led by Gary V and co. There's a lot of wild IPO markets, bananas, like Airbnb, DoorDash opening up over 100% from their offering price. The SPAC thing is going nuts. So how could cryptocurrencies not be part of that kind of party, right? So of course they are. That's not to say that the rally is illegitimate or not founded on something that's more important than just people speculating, but you have to admit that's like a large part of it. Don't forget, 2017 was one of the best years for the stock market ever, the lowest volatility, and everything went up. Every single asset class in creation went up in 2017, and there were almost no corrections. That's the year that Bitcoin took off, and it took off later in the year, just like this year. So let's keep in mind there are a lot of parallels. So when there's low volatility and people are acting up, this thing gets going, and we'll see what happens in 2021. I'm not bearish. I'm just keeping it real. People are acting out right now.
You remember any other times in the past where you've seen this kind of grab just for any risk on assets?
Yeah, I think like 2006, 2007, the Thanksgiving to Christmas period. I think we had that kind of thing going on, and it didn't end well in the case of 06, 07, but I can remember like year ends like this where people were just like, I don't care what it is, get me long. And some of that is FOMO, fear of missing out. Some of that is just institutional issues with who manages money and how they get paid and who they get compared to. And then some of that is just like greater fool stuff, like, look how much money my neighbor just made. I'm going to shoot myself in the face if I don't also go out and make money. And they're just looking for things that are moving fast and jumping in, and then they're doing research after they buy it to justify what they just did. I know what's going on. I talk to everybody. I'm not criticizing anyone. Every stupid thing that you're doing right now, I have also done. It's all good. It's not going to work out great for everyone, but it's all good.
All right. Another familiar face here. We've got Blair, fellow Ritholtzer, author of The Bell Curve.
What's up, Blair?
Yeah, so Blair, touching on a point that you made earlier with mortgage rates being so low. How do we get here? How do mortgage rates get so low? Is this sustainable? Is there anybody left to refi that hasn't?
So that I think this is one of the biggest economic stories of this year. I did a podcast with Logan Motoshami, who is one of the foremost authorities on what millennials are doing in the housing market, and he laid it out for me like this all was going to happen anyway because of demography. You just have this peak of 29 and 30-year-olds, and they're having kids now, and they are buying no matter what. But what went on this year with rates just accelerated that. We might have even pulled forward like 3 years worth of housing demand into 6 months. And there's also something cultural happening. Just people saying, all right, it was cool living in the city when I was 23, 24, 25. It doesn't mean that much to me anymore. And then they start closing everything. And you're just like, you know what? I want a house. And if you want a house, you need a mortgage for the most part, most people. And so It's actually one of the things that's worked out well, generationally speaking, that people have been able to buy houses and get financing during this pandemic and get themselves to the home that they want to be in. The only negative is that home prices are rising like 7% month over month. And even if you're selling into that market, if you're a boomer that's like, all right, I did my thing, I raised my kids, I'm going to Arizona, I'm going to Florida. All right, that's good. But for anyone else, you could be excited about your home price rocketing higher this year. But if you sell it, whatever you buy also went up. Or if you're doing new construction, which is really hard to come by. So it's not been so great for homeowners, but it's not terrible. I think it's been really good for first-time buyers. And the good news is they are most of the market, most of the housing market. The new buyers coming in are not second home. It's this group that really needed a break. So hopefully they got one.
All right, looking at Charlie Bilello's chart here, another topic that you touched on earlier with oil going negative. I looked at this chart for the first time, and I remembered, this happened on 420, and this probably isn't the 420 chart people would have expected to see after all the news in the cannabis market. But, crazy. Oil prices go negative. When you saw this happen, did you expect energy to rebound? Do you think it was a blip? Are you, seeing energy as kind of a dead asset moving forward anyway?
When I first started doing financial television, it was littered with all these these smug commodity guys, and their whole shtick was like, well, if you drop it and it falls on your foot, it hurts, and those are the assets that you want, and they can never go to zero. What are you gonna tell me now, tough guy? What are you gonna tell me now, commodity king? Now I've seen. You ever hear the expression, now I've seen everything? All right, so here's why this is important. It was obviously a very technical quirk of the pandemic reality that there was no demand for gasoline for a long enough period of time that you had to pay somebody to take okay, that couldn't have lasted forever, and it lasted days. But the next time somebody says never, and there will always be somebody that says that'll never happen, this will never happen, just show them this. Really, never, right? Well, the next time somebody tells you that a commodity will always have value, not always. There might come a day where it doesn't, right? So we have now seen oil trade at negative number. We've seen it all. There's nothing you could show me now that will shock me after that.
Yeah, I think there's a lot of things this year that, had people say never, but this is certainly one of them.
All the charts are broken, like all the long-term charts, the employment charts. The scale is so blown out that to look at month-over-month employment when we're adding or losing 20,000 jobs, we've had months where we lost 7 million jobs. You can never look at that chart again. We have literally changed the course of human history this year.
We were just talking about that here in a meeting this morning at YCharts about how so much noise on charts in 2020. When you open up a time frame on a chart now, it's hard to even see long-term trends.
It's going to be everything that you hear is going to be X 2020. Do you understand that? Mm-hmm. And you're in this business, so listen up, young man. Every single data set, every chart, every long-term everything is going to have an X 2020 caveat. Look at the data X, pull this acid trip out of the data, and what's the normalized version of the world? Because everything that went on this year was it was a funhouse mirror looking at a kaleidoscope staring directly into the sun. There's just we're gonna have to go X 2020 on everything from now on.
The ultimate outlier. All right. Well, Michael Antonelli here's got another chart showing a big dip, right? A big move. This time in the bond markets, though, right? So we've got LQD, investment grade bond ETF. This happened while stock markets were near their lows. People started saying, "Hey, I want my money out of these bond funds too." What's going on there?
So this is LQD versus LQD's assets under management. There was a fear, and not an irrational fear, that there was going to be this wave of bankruptcies sweeping the nation, and that would creep up from high yield into investment grade, and that you would have some substantial bond issuers failing. And then obviously the Fed and the Treasury stepped in working together, and they made it so that didn't happen. You could be mad about that if you want to. I think it's good. I'd rather we don't have 50 million unemployed people. I know it's a wacky opinion, but that's my opinion. So I'm glad that they took those steps so that we didn't have to repeat 2008 again, or 1929, or whatever analogy you want to use. But in the early stages of this, it really looked as though you would have this wave of bankruptcies, and people acted, and they got out of things like LQD, and you can't blame them for doing that. It's a form of de-risking, and they probably moved that money into treasuries or money markets or short-term government instruments, which are less volatile and allegedly safer. I think what's interesting, though, is that there is a difference between an index and a product. And here you can see that difference. People that want out, they don't care what the underlying index says. They want their money out. The other thing is, we don't know what percentage of the sellers were selling because they had an economic opinion, and what percentage just literally needed their money to live on. We don't, there's no way to, I mean, I guess you could take a poll, but everybody lies. There's no way to know. So and that's a good lesson about flows in general. They don't always represent someone's opinion about the future. Sometimes people just need to spend the money.
Yeah, makes sense. I like to think too, maybe some people were looking to, put the risk on in their portfolios here with stocks so low, move some money out of bonds and stocks. But
I guess that's definitely possible. We'll never know.
Never know. Similar kind of theory here, right? So looking at Tobias's chart, looking at the spread between high yield and investment grade bonds, right? So we saw this spread spike like crazy back in 2009. We saw a little spike last year. I think this was one of several kind of pending doom things that happened over the last 18 months, with the 10-2 yield inverting. How much stock do you put in these kind of forecasts for recessions, or these kind of doomsday sequences that people see in the markets? And is it just noise, or is there some legitimacy here?
Well, so I think shout out to Tobias. That's my guy. He's basically showing, I think what he's showing is coincidental or concurrent, not leading. Like, it's not a leading indicator. These things happen during a recession or a bear market. Like, these spreads blow out while things are getting worse, not 3 months in advance. But I guess what he's illustrating is that we were on the verge of an explosive move higher in these spreads, and then, like on a dime, it reversed. And it's hard to believe, but spreads are now back to where they were almost before the pandemic started. And that's just, I mean, that obviously is maybe 80% credit to the Fed and Treasury, and then maybe 20% credit to just investors being optimistic enough about the reopening and the vaccine. So you really have to give the monetary authorities all the credit in the world for not allowing the system to blow up. Because if you start getting actual defaults on high yield, that infects every layer in the bond market all the way up to treasuries. And that's how you really turn a stock market crash into a 5-year depression. And the jury's not out if we're going to have a depression or not. Like, this could go on for, I read somewhere it's going to take 29 months at current trend to get back to where we were in employment pre-pandemic. So it'll take 29 months from now, which is like almost 3 full years, if we ever do even get back there. We were at record historic lows in employment. So I think the authorities did the right thing here. I understand there's controversy, about the levels of debt and the deficit, but the alternative has to have been worse, right? So we did not have that super spike in spreads blowing out, and I think that's a good thing.
All right, so let's move on to some more topical topics here. Tesla, Robinhood traders more. We've got our resident chartist and CEO, friend of yours, Sean Brown here. Sean's showing, the, I guess, fundamental analysis of Tesla and comparing the value of a company like Tesla to Berkshire Hathaway. I guess my question when I look at this chart is there an Elon Musk premium now that kind kind of outweighs the Warren Buffett premium?
It's a religion. So I watch these guys like arguing with Tesla shareholders. First of all, Tesla shareholders have been right the whole time. No offense. You sound really bright and well read, and you sound like you've done a lot of homework here. Hasn't helped you. The bulls have been right. So I understand that could change. Hasn't changed in 10 years. They've been right for 10 years. So that's one. Two, there's no sense in arguing with people about their religion. You never see them do it in real life. So if you stop thinking about Tesla like a stock, and you stop thinking about Elon Musk like a CEO, and you start thinking about Tesla shareholderdom as a religion and Elon Musk as the figurehead of that religion, then you're done wasting your time arguing about accounting principles and cash on the balance sheet and manufacturing flaws or any of the shit that has not mattered for 10 years. And Elon has been able to dance around. I mean, this guy fought the SEC to a draw. You know what I mean? Like, so all the things that you think would normally matter with a stock, it's not a stock. It's a religion. They revert to becoming a stock someday. Short it then. When the stock starts going down on bad news, right, and not up on bad news, maybe it's not a religion anymore. But I've always said this thing's too hard for me, and I have no edge whatsoever on the technology side of it. But just like speaking as somebody with some market experience, don't short religions.
I can't respond to that. That's good advice. Our next chart from Ram Capital, another mutual friend here. He's showing an interesting picture how investors could have grabbed a piece of Barstool Sports on the cheap. I like to think of Barstool Sports as the Ritholtz wealth of the sports and pop culture world when it comes to podcasts and blogs and things like that. Curious what your take is.
Slightly less controversial, I hope. That's not what we're going for, but I like the Barstool guys. Actually, I miss Ram Capital. One of the guys I miss on Twitter. But he's doing some stuff on Instagram, so I see it, and he cracks me up. This is a cool chart. Penn is now added. I looked this up. I looked at the market cap. I might be making this up, but I think this was the number. I think they added 12 billion in what's the market? Look this up while I'm talking. What's the market cap of Penn right now? Is it 12?
It is, yeah, just under 11.7.
All right. Okay, so this is what I was trying to say. So it was 6 pandemic, and then it got crunched, and then it recovered and doubled from where it was pre-pandemic, or yeah. So you could say that Barstool is worth $6 billion to Penn, right? If you just conceptualize it like what was going on with the company pre and post the Barstool news, and I don't know if that's accurate, like in terms of like how much they'll make from that partnership, but it definitely has set them apart from all of the other casino operators. It's definitely a niche thing that they have to themselves, and hopefully they'll run with it. I don't gamble. I just bet on sure things like Starbucks stock and whatever. Like Google. Like when I know something for sure, why would I gamble? I don't understand why would I gamble. So that's not my thing, but. I guess if you're a Barstool fan and there's a venue you can go to that's related to Barstool, why wouldn't you go there? So hopefully that deal works out for everybody.
Yeah, if nothing else, it's been interesting just to see the overlap in people using the stock market and the legalized sports gambling in kind of the same fashion to scratch an itch, I guess, during the pandemic, right? So.
Listen, right, everybody can look at that stuff puritanically and scold them. People should do whatever they want with their money. It's not, what do I care, right? If somebody wants to spend like an hour on Robinhood, then bounce over to DraftKings, then go to a Penn National Casino and bet on a horse race, I don't care. But I don't understand. Like I don't understand the anger toward this stuff. It really, I think it's people that don't have enough to do.
There's certainly worse ways to use your time and money.
Well, maybe, maybe not. Not for me. Whatever. All right. Dave,
Yeah, Nate Geraci here looking at assets flowing into the Jets ETF. I think part of the point here is the Robinhood investors, buying anything that was depressed. What was your favorite kind of anecdote about the Robinhood investors from this year?
What's funny is like these are all bankrupt companies. These are insolvent businesses. It's not their fault. Like there's nothing an airline CEO could have done to prepare for the pandemic, right? It's just not their fault.
Yeah.
But these are all basically bankrupt. And the government is going to help them get through this period because this is through no fault of their own. Arguably, it's negligence on the part of the government. So anyway, taxpayers are going to let these things live. But like if you were talking to millennials they don't reading balance sheet stuff. They don't give a shit. They're just like, no, you don't understand. I'm going to be on a plane next year. I'm buying the stock. And you try to explain to them like the act of booking a flight is not the same as the act of a company actually ever making money again. Like, do you understand the cap structure and the subordinated debt holders are even above you as an equity holder? Like, dude, shut up. I'm buying the stock. It's going up. I don't care about any of that stuff you just said. I don't know what it means. And enough of them did that. These are the airlines and the Jets ETF were like top 50 actives on these trading apps. So like this is an example of like the reality being whatever the investors say it is. So you might say these are insolvent companies, these stocks are zeros. Buffett may have thought that. He blew them out at the bottom, but the market participants said, no, I disagree. And enough of them believe that they made their own version of reality. And that's what this chart is involved with. I mean, this is not the price, this is the assets, but that's $3 billion plowing into a very sleepy thematic sector ETF that prior to the pandemic, nobody ever paid attention to. I know the guy who launched it, this guy, Frank Holmes, I think he's like a gold guy. And what I think his company's called US Investors or something. They launched this thing for no reason because it didn't exist. There were no other airline ETFs because why would anyone buy that? And look at how this thing caught fire. So I think this is a great story.
Yeah. I guess it sounds like then you believe in the Robinhood effect to some extent, at least.
Well, there's now academic literature on the Robinhood effect. And what they found was that when a stock pops onto that list on Robinhood, there is a pronounced, undeniable effect on its price for the first week. And then in the second week, that effect is still there, but lesser. And then when you go past 30 days, the effect disappears. But that's not for every stock. That's like for the average stock that ends up on that list. But there are some stocks that, being part of that ecosystem of like uninformed traders who treat it like rolling dice, like there are some stocks that have had that Robinhood effect throughout the whole year because they've just never left the consciousness of that class of investor, let's call it.
All right, our next chart comes from the other Caleb. We got Caleb Silver here from Investopedia with really take on, computer chips versus potato chips, I guess. I'm not really sure what to say about this other than it's pretty interesting, but what's your take?
First of all, the semis are the new transports. JC stole that from me, but that's okay. I've stolen plenty from JC over the years. It's all good, man. I know JC 15 years. I know Caleb 11 years. These are my people. So Utz, I think, was a SPAC. So at the start of this chart, it's not Utz. I think Utz got bought by a special purpose acquisition corp and then changed the name, but I might not be 100% right about that. Utz is it Utz? How do you pronounce it?
I always called it Utz, but
Utz. Okay. Utz is, I would say, the 11th best potato chip brand in America, give or take, right? Pretty much everything is better. Like this is what you buy at a gas station at 2 o'clock in the morning. If they don't have any Ruffles or Ridges or anything from Frito-Lay, no Pringles. You could go Utz. It's not the worst thing. I would like hide the bag when you're done. I wouldn't leave that lying around. I don't really know what we're talking about here. But all right, let's go to the next one. I'm hungry, by the way.
Yeah,
so
and
are there a lot left?
Made out there too, but we could talk chips all day. All right. Next section here, technology takeover, right? Talking about just the rotation in, the economy and what's making it tick, right? So, Dave here is talking about QQQ versus SPY, really, right? So I'm curious, like, when you think about core portfolio holdings, QQQ now, I mean, is that a very normal core holding to have? Is it too technology focused, or is that a comparable ETF to SPY in a portfolio?
Well, so we run a tactical model for clients. It's not most of our clients liquid net worth with us. It's like a sleeve. And in the tactical model, we use both the Qs and we use the S&P 500. And we won't own both of them always at the same time, but usually when one is in a bull market, the other is, technically speaking. And this is like trend following. So we do have clients that look at this and they say, why wouldn't I just do Qs straight up? Like, why do I need the S&P with the Qs? Typically, there are people that have forgotten a lot of financial history, and there have been moments where you would say, "Thank God I'm in the S&P, not just Qs, but I'm in both or one." But I think what the Q names have in common for the most part is that they are more aggressive, energetic, forward-looking companies that have a bigger weighting in the Qs. They're all also in the S&P, right? But they are companies that were quicker to figure out work from anywhere. I don't like work from home. Work from anywhere is a better descriptor for this next era that we're in. They were quicker to figure these things out, or in many cases, they were already doing that. They were already catering to companies that were doing business mobile or remote. So I think that's a big part of it. And then also there's a big consumer component in the Qs. And the one thing about the consumer in this recession is that we flooded them with money that they were able to spend immediately, right? Flooded, literally sending checks, sending wires into people's bank accounts. And the difference between the stimulus in the Obama era, which was like the Bernanke-Yellen stimulus, that was trickle down stuff. That was like, well, we'll flood the Fed will flood the banks, and then if we get lucky, somebody will want to take out a loan. Nobody wanted any loans. If we get lucky, the banks will want to lend. The banks didn't want to lend. They wanted to shore up their capital ratios. So you had stimulus for banks who then didn't use it. This time, we flooded the consumer with money. And the thing is, when you give money to somebody who needs to spend it, this crazy, weird thing happens. Unexpectedly, they go out and spend it. I know that's really, really hard to process, but that's what happened. So if you look at the makeup of the Qs, it's very consumer oriented, consumer facing, or I should say those companies have a bigger, more dominant weighting. Amazon, Apple, they're in both indices, but they're bigger in the Qs and there are more of them.
Yeah, so I guess on top of all of that, it's just a matter of knowing what you own, right? When you're in these ETFs, because a lot of overlap.
And no banks really, no energy. All the stuff that is, like, there might be an airline, but it's probably this big in the index. Like, all the stuff that you didn't want is not in there. It's tech, healthcare, consumer. That's rock and roll stuff this year. That's like what you wanted.
Yeah. So, all right, next chart looks at value versus growth. I think, to a certain extent, right? So, Beth, who, focuses on tech stocks, she's looking at, Zoom here and how that's an example of a company trading at a high multiple, far outperformed companies trading at low multiples this year, whereas, your typical value investor.
Not beer. Hold on. I want the Perrier. Okay.
I saw you pouring a little something in there beforehand.
No. All right. So wait a minute. So this is great. So she's showing that Zoom price to sales ratio early this summer was already ridiculous, right?
Well,
and then it just exploded even higher.
And
Wells Fargo's, yeah.
So I think, you were talking about this a little bit on CNBC today, right? When you were talking about value and just the rotation of assets between different kind of factors, right? So,
well, yeah, these big bank stocks, it's hard to tell on this chart, but like the big bank stocks are up like 20% in the last month. So they've definitely lagged all year, but one of the hallmarks of a real bull market is rotation, and there being these phases where everything gets a chance to lead, and that's what's happening right now. It wasn't happening the whole time, but that's clear. John Roque, John Roque's a friend of mine. He was a technician for Soros, and now he's at Wolf Research. He does great stuff. But John was on my podcast talking about the fact that, and he had this realization earlier than most, like Amazon, Apple, Facebook, Netflix, these stocks all peaked in July and August. And so they peaked relative to the S&P in July and August, and the S&P kept going. So it got leadership elsewhere. And everyone thought, oh, well, if these big giant stocks stop leading, then, the market's in trouble. That actually, no, that's not what happens at all. What happens is there's a new leadership group and you keep going. So Wells Fargo, in this example, it's never going to give you what Zoom gave you. But I think what the point that Beth is making, the bigger point is, don't go by valuation if you're going to try to figure out the next move in a stock, because valuation has nothing to do with it. Zoom was overvalued and then it went up 500%. Wells Fargo was undervalued and then it got cut in half. So valuation is not going to help you. It's definitely not going to predict anything.
All right, I think this is our last chart from one of our influencers. We've got Shirl from Dynasty Partners, and again we've got Zoom on the chart here, and talking about work from home, and as you mentioned, work from anywhere. For me, it's been work from anywhere in my home because my wife keeps moving me to different rooms. But
I was going to say, you look like you're in an attic at this point. There's nowhere left for you to go.
Well, I did start in the basement, and I've just been. I like to think of this as the penthouse, but
you graduated.
Yeah.
For those who don't know, Shirl is a beast, and Shirl has built this massive business that's a platform for independent advisors called Dynasty, and I think he has like $50 billion worth of RIAs sitting on his platform, and he's providing a lot of technology and a lot of services to those firms, and he's been extraordinarily successful. And Shirl, prior to the pandemic, was able to move his entire operation from New York City, he was in Midtown, down to I think he's in Tampa, in St. Petersburg.
Sounds right.
So Shirl moved the whole thing down to the west coast of Florida and didn't miss a beat. Like, continued to do everything he was doing in New York. And I think him doing that before, people were forced to do that, but him like leaving New York City and being like, I could do everything I do here, but better, and I don't have to be in the financial capital of the world. Like that was like that presaged something that now I think a lot of businesses have figured out, which is that geography is not as important as maybe it used to be for a lot of white collar professions. So this is not the end of a trend because we get a vaccine. It's just getting warmed up. I was down in Nashville last year. Somebody showed me this. They were building this enormous glass tower in downtown Nashville. What the hell is that for? Is that for Facebook? They're like, no, it's for AllianceBernstein. Really? Mutual fund guys? Yeah, mutual fund guys. They're moving the whole thing from New York down to Nashville. So that's, I think, just going to be a permanent trend for our industry. And the only guys left on Wall Street, like physically with a Wall Street address, will be the boiler rooms. And if you run into a financial guy who works on Wall Street, run, because the only reason he's there is to have that on his business card. I think I said too much.
All right, so our last section here is just, what's been trending on YCharts, right? So these aren't as endorsed by some of the influencers as some of the prior charts we looked at, but some of the trends that we've been seeing a lot of people look at on YCharts. First one here is just, the vaccine stocks, right? And obviously the huge outperformance by Moderna in that space. The thing that jumps out is Moderna's market cap, I think, started the year at like $8 billion, whereas the rest of these were in the 200 to 300 range.
What is it worth now? It's too small.
I think they're up, what, so 800%, something like that. So
you don't have to do the math. It's crazy. This is now like a gigantic company.
Yeah. So I guess not much to say here other than the vaccine stocks have done well, and the small player that made a big splash there did extremely well.
Well, I think they were early. I think they were they were very effective in getting their name out there, but then they followed it up with execution. And I hope the thing works. I don't know. I'll take it. I'm not afraid. I'm not afraid to take it. After this year, I'm not afraid of anything. I've seen negative oil prices, my man.
There you go.
You can't scare me.
All right, our next chart. You talked about unemployment. That blip, right? Well, here we are just focused on that blip, which is 2020 in the unemployment chart. The highs there, the trend back. It was really interesting to me that you said at this trend it's going to take 29 months, because if you'd asked me to guess, I would have said that we're on a trend to be back to those values that we're at much faster than that. So
I think nobody could have foreseen unemployment getting as low as it got and the Fed still being as easy. Like we were reporting unemployment rates for college graduates of like 2%. You understand what that means? That means there's not a single unemployed person to be hired by businesses. Like everyone's taken. And we were doing that, but we were doing that in at the end of 2018 and early 2019 while the Fed was cutting rates or had stopped raising rates. So it was really an extraordinary period of time where you had this record low unemployment, but record low interest rates. And interest rates, like definitively, like the Fed being like, I'm done. And so, well, they're not reacting to the employment market by being done. So I think all they're doing at that point is like, oh no, the S&P is crashing, or oh no, there's a trade war, we better lower rates. And then you had an inverted yield curve with unemployment at all-time lows, which happened in the summer of 19. So I think, like, you say to yourself, we might have been peaking in employment anyway, and we might have been on the verge of a recession anyway, right? With the yield curve inverting way before the pandemic. The yield curve doesn't know it's going to be the pandemic that causes the recession. It just, at that point, it was probably the trade war that was going to put us into recession. But its record continues to be unblemished. It's gotten them all right, and it got another one right this year.
Yeah, no, it's interesting. You mentioned the unemployment earlier. I think you were talking about interest rates and how they were, or mortgage rates. That trend was kind of happening, right? So the pandemic, I mean, it seems to have acted as a catalyst to really just make a lot of these trends that were happening happen much faster, or speed up some of these big events.
Yes.
And here's a buzzword that you don't hear as much as you did back in March with the beach industries or the beach stocks.
What is this? Is this a thing?
It was, right. It was trending a lot back in, I want to say, March. Looking at a group of companies, booking, entertainment, airlines.
This was a thing? How did I miss this?
Maybe it wasn't quite as big as
you just made this up.
Go look back.
Beach
we had Ben on back in, I want to say, February or March. We talked about this a little bit, but
he ain't using that term in front of me. Dude, I'm on financial television like 26 hours a day. I've never heard somebody say the beach stocks. I don't dislike it. So, all right. So what is it? Booking companies? What is that, like Expedia?
Yes.
Right. And then Live Nation, and then like airlines, Carnival, Marriott. All right. I'm stealing it. I have nothing else to offer, but I'm stealing that term. I never heard it before.
Maybe the one encouraging thing here is that the group, or the group within this bigger group that's come back the fastest are the booking companies, right? Or
they should be the leading indicator, right? If they're seeing money, then everyone else will see money a month later, right? So
seems like it's
yeah. They're also asset light. And one of the things I was saying to people this summer, they're like, I want to take a shot on Carnival, or I want to take a shot on American Airlines. It's like, dude, just buy Expedia, because they're both going to recover at the same time. But the difference is one of them doesn't have to own the plane.
Yeah, that's smart. I mean, you were talking about the balance sheet, right?
Yeah, and Wall Street is paying like 20 cents on the dollar for revenue from American Airlines. they're paying like $30 on the dollar for Expedia's revenue, right? Just look at it. Like, why would you want to own the asset-heavy business with all the debt? Own the internet company that doesn't have to wipe down a plane every 10 minutes, or service a cruise ship. So that was always my take on. Of course, I didn't take my own advice. I should have bought Expedia at like 70 or 80. I knew it was a buy. I just I was busy working on my abs.
Well, you made up for it by coming up with the beach stock term. So
yeah, look at that. That's that's good.
All right, this is our last chart. Cash on the sidelines, right? So just looking at as the market moved this year, institutional money funds still seeing that big growth, right? So did investors participate in this bull market?
I think they did, but in ways that were unexpected. I think they threw themselves into individual stock trades, which is a really interesting thing to think about in future market crashes and events. I think individual investors saw the market crashing, and they were nervous, but they also said to themselves, like, look at this opportunity, right? Don't forget, 2019, the stock market went up 30%. Like when the market is trending like that, you can't breathe. You can't think straight. And every stock that you're about to buy, you go to research it, it's up $10, right? So like that was what was going on in 19. We started in January from that trade war low and just built all year, built. So 2020, in the first 3 months of 2020, you had a 30% crash. And people, they're not like, oh, I can't wait to buy SPY, because their 401k is going to do that for them automatically. This was like, oh my God, I have to buy, name it, Home Depot. I have to buy Facebook, Netflix, whatever, right? Like those were the trades people wanted to do individually. And then the more daring people wanted to buy like Las Vegas stocks and airlines and whatever. But like people threw themselves back into, I don't want to call it active management, not really managing, but people threw themselves back into this love affair with individual stocks that's been missing for almost maybe more than 10 years. So I think that was really interesting. The cash on the sideline stuff is very misleading. There's no signal there. I think you should like just remove it from your process. People that try to trade on that stuff, there are mechanically so many things going on that make that hard to really take anything away from. And then again, just to point this out, certain times people go to cash not because they're afraid of stocks, but because they have to eat. And this year especially. So don't focus so much on that stuff.
All right. Well, that's our last chart. It seems like a good place to end.
Let's do like 20 more. I'm good. I don't have anywhere to be.
We're gonna have to make them up on the fly. So right. I'm out of content, but no, can't thank you enough for joining us today. Really appreciate it. Always love your insights. Always love hearing you speak wherever it might be. So, especially honored to have you on here with us talking about YCharts.
It was my pleasure. Caleb, you did a great job, and thank you to YCharts. Love YCharts, and thank you to YCharts Nation for watching. We appreciate it.
All right, thanks. Remember to put the how I invest my money in your stockings.
All right, bye guys.
Bye everybody.